What's good, y'all? It's your boy Dee Brown. We're going live. We're going to talk about day trading. And hopefully, I do a good job of teaching y'all how to day trade or giving y'all kind of like the basis of day trading and things like that. So, stick around for the video and everything like that. Want to make sure that y'all can hear me. Cool. So, let's go ahead and get into it. I got my notes and bam. What is day trading? So day trading, I just pulled up the definition. Day trading is a high-risk investment strategy involving the buying and selling of securities within the same trading day to profit from small price fluctuations. It's fast-paced and an active form of trading where positions are closed and open within hours or even minutes. It's crucial to understand the risk involved. So I wanted to make sure I give y'all the professional version first. Basically, what day trading is just in the word, is trading within the day. People who day trade are usually people who don't like to have jobs, or they're tired of their job, or they want more time in the day. Another way of financial freedom, but it's a learning curve as well. So day trading is trading within the day. You can make the same amount of money somebody makes in 8 hours in maybe 10, 15 minutes, an hour, just depending on the day. Day trading is something that kind of looks like stocks. This is an example right here where you can see this different price action, these green and red candles up and down, up and down, up and down. But it looks just like the stocks. When I was younger, I never really understood why people was always talking about the NASDAQ, the Dow, and all that different stuff, or why it was even popping up on my phone. Well, this is why, because people have long-term investments, which is basically put your money into a stock, let it sit for years, and you can have retirement, or you can day trade, either or. So that is day trading, traded within a day, being able to make a certain amount of money or whatever amount of money that someone else makes in 8 hours a day, 16, or whatever the case is. All right, so now the second thing is the different types of day trading. So one of the types of day trading is options. I don't trade options, but I will read the definition. Day trading options is a strategy that involves buying and selling option contracts within the same trading day to profit from short-term price fluctuations in the underlying assets. Basically, how it works, options contracts provide the right, but not the obligation, to buy, call, or sell, put an asset at a set price, strike price, before a specific date or expiration date. Basically, what happens is when you're doing options is when you're looking at a chart, and I know if you've never seen day trading, don't worry, I'm just trying to show you a chart. If the price is up here, basically with options is you're trying to say, hey, I want to put in a certain amount of money. That price is going to reach all the way up there where that dotted line is, or where I just turned it into a straight line. So we're saying, hey, at the end of the day, I'm going to put $100. I'm going to put $100 in now, and I'm betting or calling that price is going to reach here, go above here, or even stay below, just depending on the trade. That is options. I don't trade options. I trade futures. So what are futures? Day trading futures involves buying and selling futures contracts within the same trading day, aiming to profit from price fluctuations. The strategy is popular for its liquidity, volatility, and potential for diversification. Highlight liquidity and volatility. Volatility would be how fast it's moving. Liquidity will be where the price is currently at. But it carries significant risk and requires a strong understanding of the market and risk management. Basically, I'm reading these definitions trying to be professional, but what futures is, remember we said with options, you're betting that it's going to go up here. You're saying, hey, it's going to go to this price. If it does it, you get money. If it doesn't do it, you lose money. For futures, what futures is, you take what you can get. So if it's going up, and I say, hey, I think it's going to go up, no matter how far it goes up, that's how much money I get. It doesn't have to reach a certain price. It's just going up, and like I said, I'm taking what I can get. That is futures. I personally trade futures. So, sorry for the background noise. So basically, I want to get into futures. Basically, we're going to get into the things that I do, which is futures. I won't get into options because I'm not skilled in options, but I wanted you to know what day trading was, the different types of day trading. There are many types of trading, but there are types of day trading as well. If there's more types of day trading, I haven't heard about it. It's not for me. So I wanted to get into the next thing would be TradingView, which is what I've been showing you right here. This is a website, tradingview.com. Tradingview.com is a charting site. So when you day trade, what you have to do is plan or chart. It's not as easy as hitting the buy button, this blue button, or hitting the sell button, this red button, and saying, I want to make some money today. That's not how it works. So TradingView will help you chart. For example, here you are right here. So this is my chart. I will not go over this specifically right now because it's too much. We'll go step by step. You see these boxes, you see these dots, you see these lines. This is kind of what I go through as far as charting. But this is TradingView. TradingView has different markets: Apple, S&P 500, Dow, Tesla, anything that you can find on your stocks or even your Cashapp stocks. All right, that's TradingView. TradingView is used for charting. It can also be used for trading. So you would connect TradingView to your broker. Highlighted here, broker. What is a broker? A broker is, you can think of it like a bank account, but not really. A broker is somebody or a website or an app that you give money to in order to start trading. So basically, my broker is Tradeovate. And Tradeovate is turning into Ninja Trader, which is why you see Ninja Trader here. So Tradeovate is just one broker. There are many brokers. So you find a broker, you say, hey, I want to put this much amount of money into it. Let's just say $500. You give them $500. The $500 clears, and now you're ready to trade. And you can go to TradingView, connect it to your broker, mine is Tradeovate, and now you can use that $500 to trade. You are using the money as leverage to make more money. But the downside is you can also lose that 500 as well. So hopefully you're with me so far as we go through day trading. So day trading, trading throughout the day. Types are options and futures, and you need a broker. Mine is Tradeovate. I already went over the buy and sell buttons, but I'll go over it a little bit more. This blue button is buy. This red button is sell. Sell means we're going down. So the more it goes down, the more money I make. The blue button buy means you're going up. So the more it goes up, the more money I'm making going up. All right. That's the buy and sell button. I also wanted to go over something called demo trading. At the bottom here, you see where it says paper trading with this green dot. Basically, it's practice. You don't have to start day trading with your real money. You can practice for God knows how long. 3 days, 3 weeks, 5 months, 3 years, unless something changes in years, 100 years if you live that long. So you can practice. This is fake money. It doesn't have to be your real money. They're not asking you to put your real money in when you start day trading. They want you to practice first. Or you should, or I would advise you to practice first. So that is demo trading. So you can trade options or futures. And the thing about options and futures, how do you know which one to trade? You really don't. I trade futures because I was introduced first to futures. The person who introduced me to futures started with options. He lost a lot of money in options, so he went to futures. So it's just something I started with. Futures is just something I started with, but you can do either one. and then let's go over markets. So I'll go over the markets that I trade. So I don't know if you've ever heard of the S&P 500, the Dow, and the NASDAQ, and the Russell. Those are the four major markets. Those markets include several other stocks. So each one has a different set of stocks, which is why they're so important. They're the main markets in, I believe, the country. Actually, I think the world. So what I trade is, and I don't know if you can see this right side of this panel, but I will actually click it. At the top left corner right here, you may see where it says MES1 exclamation point. There we go. ES stands for S&P 500. That is what I trade. I trade the S&P 500. This M stands for micro. So basically, there are standard contracts and there are micro contracts. Standard is for the big dogs. Micros are for people like me and you, cheap people. So in order to trade, depending on your broker, let's just say you chose the same broker I chose, Tradeovate. There are certain stipulations that you'll have to see on your own, but I will give you one right now. On a micro contract, the only amount of money that you need to trade, the minimum is $50. That does not mean that you trade with $50. That means that's the minimum. But if you start trading with 50, you'll get kicked out of the trade, because if you go below 50, then they're just going to kick you out. So basically, the goal is to stay above 50. So you can put 100 in, and if you get close to 50, get out of the trade, or it's going to kick you out of the trade. So the minimum that you have to have in your account for the S&P 500 micro is $50. I believe if you're not trading the micro, which up here says MES, the standard would be just ES. I believe you need $500 minimum. All right, so I don't do the big dogs, I do the little dogs. So all I need is $50, really more, like 100, 200, something to kind of give you a little leeway, and you're able to trade. Also, right here is the MYM. YM stands for the Dow. The MNQ stands for the NASDAQ. I believe you need more than 50. I believe you might need 100. These are called margins, by the way, those minimums. The margin you need for the NQ micro, I believe, is $100, because it moves so fast and it's very, very volatile and sometimes dangerous. And the Russell. So those are the markets that I trade, but mainly the S&P 500. Now, strategy. Strategy is important. My strategy is called the Strat. All right. Let's see if I can Google that. What is the Strat? Let's go here. All right. The Strat is a price action trading strategy developed by Rob Smith. Rest in peace to Rob Smith. He just passed away a few years ago. Focusing on candlestick patterns. Candlesticks would be these. They look like candles. Focusing on candlestick patterns and market trends to identify potential trading opportunities across multiple time frames. It emphasizes a systematic, non-emotional approach using specific candlestick patterns such as inside bars, directional bars, and outside bars, along with time frame continuity to analyze market movements. All right, so what are candlesticks? This is very important. So in order to know what the Strat is, you need certain indicators. One of the indicators that I have is called candle type the Strat. I'm not sure if you can see it, but right here it is called candle type the Strat. If I hide it, you see those numbers go away. If I bring it back, those numbers are back. All right. Red candle means it was going down before the candle closed. Let me zoom in. This red candle means it was going down before it closed and went over to the next candle to the right. Green candle means it was going up before it closed to the next candle. All right. Let me take this yellow off. All right. So only green and red candles. The strat identifies each candle as a number, 1, 2, or 3. All right. So the 1 is classified as an inside candle. Here we go. Which would be this gray candle. If you look to the left of this 1, it's a candle that's bigger than the candle that says 1. It's bigger going up and it's bigger going down. So that 1 is an inside candle. It is inside the previous candle. I'm just moving it over a little bit. This 2 that's next to this 1 is lower than that 1 candle. Is lower than the previous candle on one side. The top is still inside of the previous, but the bottom has stretched out past the previous candle. That is a 2 bar. The same as this other 2. It has broken the previous candle going up, but not going down. That's a 2 candle. And a 3 candle, and they don't have it here, but they do have it here, but I want to see y'all to see something. This 3 candle right here that you see is bigger than its previous candle on both sides, which is a 3 candle. 1 is smaller than the previous candle on both sides. 2 is bigger on one side or the other side. And 3 is bigger on both sides. These numbers are very important. Once again, green candle means it was going up before the candle closed. Red candle means it was going down before the candle closed. It's very important because we'll probably get into it later. But it's just good to know those things. That is one part of the strat. Another part, before we get into the other part, those numbers are very important because those numbers let you know when it's time to get into a trade, you're looking for these numbers. We'll get into that later. All right, so another part of the strat is using time frame continuity. Let me see if it's on my. All right, here we go. Time frame continuity. What time frame continuity means is that on different time frames, we want to trade when most of them, if not all of them, are going in one direction. So you may see it here. This H, D, W, M, Q, and Y with arrows going up and down, green and red arrows. Basically, the goal is to, when all candles are going down, or when all candles are about to go down, you want to be going down with it. If they're going up, you want to be going up with it. It's not always perfect, but it helps. That is time frame continuity. So each hour, this arrow will update. Each day, this D arrow will update. Same for week, month, quarter, and year. And the third part of the strat is broadening formations. All right, so this part may be easier or harder for some people. It just depends on the person. But broadening formations is important. Why are we going over broadening formations? Why is the strat important? Why is trading like this important? Basically, when you're trading, what most people are doing is they're trying to catch the direction as early as possible. Okay, so we'll draw a broadening formation. All right, so what a broadening formation is and how you draw one. A broadening formation is when you connect a lower low to another lower low and a higher high to another higher high. So I only do the obvious ones personally because it can get confusing. So let's choose, and it doesn't matter which one. I want to zoom in a little bit. So let's draw one here. So a higher high is a candle that's higher than the previous one and higher than the one after. So if I zoom in really, well, matter of fact, this is an obvious one right here. This candle is higher than the one before and the one after. That candle right here, okay? So it's really high. And then there's another one, I don't know if you can see it, but it's right here. I'm gonna stretch it out. This candle right here is also higher than this one after it and this one before it. So I'm gonna connect the broadening formation here to that one. Or if you want to, we can connect it to this one because that's another one where those two dots are. Or if you want to, we can connect it to this one. That's probably a little clearer for y'all. So I connected this higher candle to one that's even higher than that one. Okay, that is a higher high. And then also a lower low to another lower low, which is here. If you want to connect those, or maybe you want to connect this one like that, or this one like that. This candle is lower than this previous one and the one after. This candle is lower than its previous one and the one after. This candle right here is lower than this previous one and the one after. This is a part of the strat that's very important because, first of all, a broadening formation has this little megaphone look. It's not always going to be perfect. And if I'm being quite honest with you, I've kind of strayed away from it. But when I started, this is what I was doing. So when you start trading the strat, the first thing you want to do is draw a broadening formation. Higher high to another higher high, lower low to another lower low. And the thing about price action, from what Rob Smith says, is that price is going to move in broadening formations. So anytime it goes up and touches this line, this broadening formation, price is going to attempt to go down and touch the next line. And then it's going to try to go back up as it did currently. All right, let me zoom it out. As you can see, and I did not plan this, I just randomly drew some broadening formations. It moved up, I touched this line, it's trying to move down, we touched that line, it tried to go up, but it went back down, touched that line again, and now it's going up, and then maybe it'll go back down. Our goal is when we draw this broadening formation, let's say it touches down here, we're trying to catch it going up, okay? So if we try to catch it up going here, we get a little bit, but not a whole lot. It goes back down. Let's try to catch it up again. Boom, you make a lot of money. Now you try to catch it back down, all the way down to this line. So that's the goal. Think of it like a marathon or a sprint. You see people all the time, they're trying to get in trades. It's going up. So they try to get in going up, but it could run out of gas, just like a sprint. You don't want to enter a trade when all the sprinters are almost done with the race, when they're tired and gassed out. They may slow down and you're not going to get much out of it. You want to kind of catch the sprinters when they first start, or when they get 2 or 3 steps in. That's the goal of these, what people call reversals. We're trying to catch the reversals when they start. So with this one, whenever it starts coming down a little bit, we'll try to enter it down and try to make a lot of money. Even though I'm explaining this, there are things called directional biases. And remember, I told you about time frame continuity. As you can see here, day, week, month, quarter are all green arrows going up. The only one going down is the one that says H, hourly. So going down on something like this wouldn't be the most wise. What you would want to do is you would kind of want to wait for it to go down and then catch it back up, because these arrows are green. All right, so that's kind of how you want to do it. You want to use these broadening formations together with that time frame continuity, so you're going in the right direction. Once you find an entry, or once you're looking for an entry, basically, once again, those arrows are going up. So if this price action goes down to here, you're saying, okay, I'm gonna wait for it to go up. In the midst of waiting for it to go up, you have these combos, and these combos help you enter in on that trade. Strat combos, you have a bunch of them. You have this 2, and they're just number combinations, so don't think about it too hard. You have this 2-1-2 bullish continuation. It's a green 2. The one color doesn't matter, and another green 2. And basically your entry is right here where this dotted line is. When that 2 This 2 is going to be a 1 when it starts. Until it breaks where that 1 is, it's going to be a 1. And then it breaks, it becomes a 2. And you get in the trade. All right? And your target is this first candle, 2, 1, 2. Your target is here. All right? It's based on the first candle. Same thing for the 2, 1, 2 bullish reversal. Same concept. 2, 1, 2. Your entry is where the top of that 1 is. Bullish means up. Bearish means down. Your entry is here. You get in. You're aiming for the top of this candle or more if you're greedy. So, as the helicopter is in the sky, hopefully you still hear me. We got a 3, 1, 2 bullish reversal. 1 second. I actually think that's the news. So you have all these different combinations. Let's go over bearish. Bullish is up, bearish is down. So bearish is 2, 1, 2, bearish continuation, down. Same concept going in the opposite direction. You got this 2 candle, you got a 1. Remember the concepts I went over? Remember the concepts I went over with the numbers? 2 broke the previous candle on one side. The 1 candle doesn't break either side. As you see, it's smaller. The 2 candle broke one side. As you see, it broke one side of this 1 candle. This 2 is already here. This 1 is already here. This 2 is forming. You're trying to catch it forming. So it's a 2, 1, 1 at first. It breaks this 1 candle. You hit the red sell button. And you're going down and you're aiming for this target right here at this first 2 candle. What this picture doesn't show is that you need a stop marker. Stop markers will basically save you from losing a lot of money. You always want to put your stop marker at the bottom of this 1 candle if you're going down. If you're going up, well, the top of this 1 candle if you're going down, or the bottom of this 1 candle if you're going up. It saves you. Like if you trade and you don't use a stop marker, and what a stop marker is basically, actually, let's use something here. All right. Let's say you find I'm looking for a strat. All right, here we go. Right here. Y'all don't know it. I didn't go over it yet, but let's say you see this 3, 2, 2. That 3, 2, 2 on the left side of the screen. And I'm going to show y'all it on this piece of paper here. 3, 2, 2 bullish reversal. 3 bar, 2 bar. This 2 bar is forming. It's a 1 bar before it becomes a 2. Once it breaks the top of this 2 candle, it becomes a 2. And you get in on the trade just like here. When this candle is forming, and we're paying attention to this red 2 right here, of course it already happened, but it's our example. Once it breaks this orange line, which is the top of this 2, you hit the buy button, boom, you're in the trade, and it's going up. As you see this long wick, and the wick means that's where price was, but it's not there anymore. It was going up, it hit the target here. That's the target, the top of this 3. Let's go back to the top of this 3. That was the target. The entry's down here. Pay attention to my orange lines. Entry for this 2. Once it hit here, you're out of the trade. But the stop marker is important because you want your stop marker down here, but it's also at your discretion. You can put it at the bottom of this candle that you got in on if you want to. So basically the entry is here. You can put your stop marker at the bottom of this 2, or to give you a little bit more room, You can put your stop marker down here. What a stop marker is, basically, when you're trading and you're not using a stop marker, that means no matter how far this trade goes, that's how much money you're losing. If you only got $200 in your account and you can't go below 50, remember I said certain markets, there are minimum margin requirements. It means that you can't go below a certain number. If you have $200 in your account, you can't lose more than $150. If you don't have a stop marker, then you can lose a lot of money. We'll just put it like that. A stop marker will save you from losing a lot of money because each point is a dollar value, okay? So stop markers are very, very, very important. All right. So I want to show you, and just know I'm showing y'all love. I did not want to trade using this account because I'm actually doing a challenge for myself with this paper money. But I will show y'all. Is the market moving? I don't think so. The 4th of July is tomorrow, so I don't think oh yeah, the market is moving. So I'll hit the buy button for you to see. If you can see, there's a dollar value of negative 50 cents right here. This is a 212 going up. Weirdly enough, we got in on a trade with a strat combination. How lucky can you be? 212 bullish continuation going up. 212 entry here, exit up there. So you can see this blue line at our entry. You exit right there, but I'm just giving you an example. You can see the dollar amount that you're making or losing, and this SL stands for stop loss. You can move your stop loss down here. If you're looking very carefully at the screen, you may be able to see where it says $36 negative. There you go. 36. That means if this trade goes down here, I'll automatically lose $36. If you're not using a stop marker, it could take you out all the way down here. As you see, the number increases. Always use a stop marker, basically. That's basically what I'm saying. It's your safety net. You can put it down here at the bottom of this one if you want to, which is negative $49, or you can put it up here at the bottom of this 2. In this case, it will be negative $36, but your goal is to go up because we just hit the buy button, and you'll see it go up and down and things like that. Once again, I did that out of love for y'all. I wasn't supposed to do that because I'm keeping up with my money for myself. Anyway, we'll exit out of this trade. So I just lost $7. I just got out of the trade. That's how this works. All right, so now that I've shown you that, so I've showed you the strat indicators. I'm gonna show you that again. Indicators are basically tools to help you trade, and you can search indicators on TradingView and things like that. So the indicator would be candle type. If I hide it, no more numbers. If I don't hide it, there's numbers. There's something I call inside bars. Inside bars show you ones, or I won't go over it, but you can see these yellow candles. They mean something to me. I told you about this H, D, W, M, and Q, and Y. I can hide that. If it will let me, there we go, right here. You don't see the H, D, W, Q, and Y no more. Hour, day, month, and week, or year. If I unhide it, it's right there. Those are some indicators that I use. Zones. Let's go over zones. All right, so zones, and I wanted to go over zones because I don't use broadening formations anymore. Personally, I just strayed away from them. Remember, I thought I had my broadening formations. I thought I showed y'all that, but I guess I deleted them. All right, so remember, broadening formations when you connect a higher high to another higher high. Here's a candle that's high connected to another candle that's high. Same thing for the bottom. a low candle to a lower candle. Let me zoom in. Um, and since this market keeps going up, it's hard to find a lower one, but I'll find one here. Even if you can't tell, this is just for an example purposes. Everything isn't going to be pretty. Everything isn't going to be perfect. That's just life. All right. Actually, I'm going to use this one up here because it looks prettier. I'm going to delete this one. So this is a broad information. Remember what I said about broad informations. Once you connect a higher high to another higher high and a lower low to another lower low, you're waiting for price to break that line and you want to go in the other direction. Currently it broke the top, you want to wait for it to go down. However, zones are a little differently because I've strayed away from broad informations. Zones are very, very different. Zones there are supply zones. Let me write it out. Supply zones, demand zones. There are two types of zones, supply zones and demand zones. Supply zones is a box that I would draw to help let me know when to go down. Let's see if I can find one. Here we got one right here. In order to find zones, your goal is to find something on this chart, anywhere on this chart where it goes. For one example would be this one. Anywhere where you see candles for a supply zone, anywhere you see candles kind of going up and then it shoots down, you just see red candles. This one right here. It can be more obvious, it can be less obvious here. Supply zones let me know when to go down, which is why I do a red box. That's just for me. This is my strategy. So it shot down, it was red. I was like, okay, I'm going to put this box here. And anytime these prices go back in that box, it's going to let me know when to go down. So I'm waiting. It's up here. Okay, cool. I'm waiting for it to go down. Oh, looky here. Remember what I told you guys about the strat combination? I'm going to hide something. 2, 1, 2 down. What happened? It got in that box right there. So I'm waiting. I'm watching. 2, 1, 2 down. 2, 1, 2 down, bearish reversal. Just like on our sheet. Once this 2 crossed this 1, I hit the red sell button and I'm just waiting for it to go down. And it goes down, it goes down, it goes down, it goes down. You're making money, right? Until it goes up. Cool. Easy, right? I hope so. I hope you're not confused. Same thing about demand zones. So supply zones, in order for me to draw this box, I waited for something to shoot down really fast. I drew a box at the top of it before it shot down. I waited for it to get back in that box, and I get into make money going down. Same thing about demand zones. As you see over here, it shot up really fast going up. So this will be the opposite of a supply zone, and you just draw your box here. Or for example purposes, I'll actually, let me delete this. It'd be better if I draw, crap, sorry. Here. It went up right here, so I'm gonna draw this box. It said this time is gonna be a green box because this is a demand zone, not a supply zone. Once it touched that box, we drew it here, it touched that box just barely right here. I go back to my sheets because 2, 1, 2 going up. I go back to my sheet. 2, 1, 2 bullish reversal going up. 2, 1, 2. I enter where the 1 is at. Well, I enter where the 2 is at when it breaks that 1. Here. It touched that box. 212 going up. I enter the trade. I hit the buy button at this moment, and it goes up and I'm making money. All right. I use those boxes. I wait for price to get in those boxes. Then I use this sheet. You can Google it, the strat combos, and you'll find it online. So that is what I do to trade. We have something called levels. Levels are very important because there's something called demand zones and supply zones that we just went over, but there's something also called levels. Those levels let us know that price might change direction. It might not. It's just like keep your eyes open. Those levels can also be where supply zones and demand zones are. So this demand zone is a green box, right? Let me delete it. All right, cool. So levels is resistances and supports. Support would be like the floor, and resistance would be the ceiling. Just like the supply zone that I drew. Oh my God. Just like the supply zone that I drew, this is a ceiling. The demand zone that I drew, it's a floor. I'm gonna draw it back on here. That's a floor. That's why I drew a green box. You can't go below the floor. You gotta go above the floor. Red box, you can't go above the ceiling. You gotta go below the ceiling. So if I delete this, this is also a resistance. Resistance and supply zone go hand in hand. Demand zone and support go hand in hand. I always like to say that one can be the other, but the other one doesn't also have to be the other. Resistance can be a demand zone, but a demand zone is a resistance, but a resistance isn't always a demand zone from my definition. Where this yellow line is, I drew that right there because that is a resistance. Why? A resistance is an area, let's draw it lower, an area where candles hit multiple times and they just can't go higher. This candle, it can't really go higher than this line. It's having a hard time going higher than this line. This one never reached. So it kind of gives you an understanding of, hey, when it touches this line, it may go down. It may not, but it may go down. Same thing as the bottom, just like a demand zone. This green box, if I delete this green box, remember it's the floor, so we're drawing a support line. So this is, you can see these candles right here. Let me delete this one. These candles never really got below this area, so I draw this line, and these candles never touch that line, so it's the floor, so you can kind of expect it to go up. Those are levels. Levels are important because once you get in the trade, remember, I'm going to draw my demand box here again, the same one I drew before. Demand box because it shot up really fast, so I'm going to draw a box here. It's before any of this stuff happens. It goes there. We're in the trade. If you look at these candles right here, you can see that these candles never really got higher than this. So if you're in the trade right here, from that combo sheet that I showed you here, 212 going up, once this price keeps going up, you have to beware of this line that you drew, because it can easily go back down into this box. If you're going up, you make money going up. If it's going down, you lose money. So you want to go up as far as you can before you lose money. Fortunately for this one, it kept going up. But those are levels. Levels are resistances and supports. The top would be resistance, the bottom would be support. It's just ways to help you not lose the money you made. All right, so let me go through my daily routine and I'll end the video here. So when I wake up in the morning before 9:30 hits, because in day trading, unless you have an absorbent amount of money, a lot of money in your account, then you can only trade between day trading hours, which is 9:30 a.m. Eastern Standard Time through 4 p.m. Eastern Standard Time. There are other rules, but we'll just use that for example. And when I wake up in the morning, I'm looking for all those things that I already showed you. So right now I'm on the hour time frame, and I'm drawing things on different time frames. So If I'm looking at this, then I see it shot up really fast right here. And this is real time, but it's a holiday, so the market's about to close. All these green candles that shot up. So I'm going to draw a demand zone right here in the morning. Boom. If price goes down in there, I'm getting ready to go back up. What else do I draw? Well, I draw it here, but I also see the same thing happen here. So really, it doesn't matter where you draw it as far as which candle you started at. Me personally, I just like to draw it. So for this example, if I draw it here, if the candles are going up green just like that, I usually start at the red candle and I draw the box there. If there are other boxes that are of importance, I'll draw those as well. One moment while the helicopter goes by. I just rewind time, so let's delete that box. For a supply zone, I would draw a red box here. It's not the prettiest, but you know, it's something. I just draw boxes in areas of importance to get me ready for the day. And if I fast forward time a little bit, you can see, will it reach this box? Boom, it shot through that box. It never stopped, so I was never able to go down. But that's just kind of how things go. You draw those boxes, you see if it's going to go down or go up based on whatever box you drew. And that's basically what I do throughout the day. And whenever it reaches that box, I use that strat sheet, this combo sheet, and then I get into my trades. Outside of that, that is my daily routine. I will show y'all my current chart right now. Before we go, with all these lines, let me delete some of these. And the same thing I just told you is where my notes are. You can probably see my notes on the screen. My notes on the screen, it says, remember, wait for zone direction. So the zone is the box. Wait for price to get in that zone. Wait for zone direction. Basically, if it gets into the demand zone, the green box right here, I drew that previously. You wait for it to go back up. So I drew it here. Price went down into it and it went up, and I made money off of that. Strat on bigger time frames. So that means that I'm looking for the move on the bigger time frame. If it hits a box on the hourly, I can expect to be in a trade for about an hour more or less. If I do it on this 4-hour chart, I can expect to be in that trade for maybe 4 hours more or less. If I do it on a 15-minute, I can expect to be in on that trade for 15 minutes more or less. You want to find the big moves so you can make big money. All right. And the last but not least, well, not last but not least, but actionable one bar. One bars are important to me because in these combos you see 2 1 2, 3 1 2, 1 2 2. There's a lot of ones in this sheet. Now I know there's some that say 3 2 2 or 2 2, but most of these have ones in them. To me, ones are very important just from experience. Anytime I see a 1 here, when it reaches into my zone, that is important to me, and it lets me know when to get ready for a trade. Because you can imagine, if you've been trading the strat for a long time, there are a bunch of 2s. There are 2s everywhere. Even though this sheet does say 2-2 continuation on up or down, bearish or bullish, it can get confusing. So I made it simple for myself, which is why I put actionable 1, and also I put strat, smaller strat execution or bigger. So basically what's going on is, if I find this combination, let's see, I found some yesterday. Today wasn't as pretty. All right, so this box right here, let's say, actually let's move this back because it's valid. It was back here. All right, so, and let's rewind time. Let's rewind time right here. Okay, so We're waiting for it to hit the box. We're waiting for it to hit the box. We're waiting for it to hit the box. 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 Still waiting. Still, it hit the box. It hit the box. So we're waiting for it to go up. If it does, it's not guaranteed. Boom. 2-1. We're in our zone. 2-1. And I have an indicator called inside bar visualizer. So for me, ones show up as yellow just so I can see it better. So when that 2-1 happens, you're expecting a 2-1-2 if you're going up here. So you can wait for the 2 bar to happen, which means that this next candle would have to break the top of that 1 to be a 2, the one that we don't see yet. You can get in the trade up there, but for me, I know that if I enter a trade on a bigger time frame, I'm risking more money. So I'm going to a smaller time frame from here. This is the 5-minute. This is the 10-minute. This is the 15-minute. We found that on the hourly. So I'm trying to find something else, these same combinations on a smaller time frame. It's not guaranteed. You may find it, you may not find it. That's just life. So you're just flipping back and forth between things under the hour to see if you can find that combination that you're looking for. Let's see what time that hour is. So that hour is at 10 o'clock. As you see, this 2-1-2 did break at 10 o'clock. Was there anything at 10 o'clock that showed us that we could get in? Yes. Right here. 1, 2, 2. So I draw another line. As you can see, this line is lower than this one because it's on the 5-minute time frame. This top line was on the hour time frame. Okay, it broke at the hour, but down here is the 5-minute. We're gonna do some math because I want to let y'all know this. Remember I told you about stop markers. You can place your stop marker here at the bottom of the active candle, or you can place it at the bottom of the 1. If you place it at the bottom of the 1 and you get in up here, we're going to do some math. You don't have to understand it. Each market has a different price for each point or tick. All right. So in the S&P 500 micro, each point is $5. Each 1 point is $5. Each 1 point has a tick, which is 0.25. So the market moves 0.25, 0.50, 0.75, 1 point, which is $5. So if you do the math here, I don't know if you can see, I don't know if my head is in the way, but where you got in says 62.49. This stop marker says 62.37. Those orange numbers, that's 12-point difference. Each point is $5 on the S&P micro. So 12 points times $5 a point, $60. You're risking $60 if you put your stop down here. If you put your stop up here on the hour, this is a 4-point difference. It's a 4.25 difference, which is 4 points times $5 is $20. You're risking $20, but add an extra 0.25, which is $21.25, somewhere around there. I'm not the greatest at math, but the point of me saying this is if you do this way, let's say you're risking $20. The whole purpose of me going to the 5-minute is so that I can risk even less than that. So this yellow line is the hour. We'll delete it. We're getting in right here on a smaller time frame. So now the difference is 2.25 points. All right. So 2 points times $5 a point is $10. And add an extra 0.25. That's like $11.25. So imagine risking $11 on the 5-minute versus risking $20 on the hour, or maybe even $60, just depending on where you put your stop marker. Basically, the purpose of the strat is for you to not lose a lot of money. I will make I try to make $100. The other day I made $100 and I only risked $6. If I was wrong, I lose $6 instead of 60 or instead of 100 or 1,000. I've risked $6 and I made 100. There's other traders on YouTube that will risk $1,000, $100. All these different strategies don't really prepare you for a loss, because the point of this game is to make money. But the big point of this game is to not blow your account. Once the money you put in your account goes below the minimum, basically if you need $50 to play this day trading game and you put $500 in, you lose $450. You can no longer trade anymore. You have to put more money in. Think of it like gambling. It really is gambling. So the goal is to not blow your account, which is why this is important. Depending on where you put your stop, I can't tell you where to put your stop marker. If you're getting in at this top candle, I'll make it a dotted line. If you're getting in right here, which is once again is where this says entry. If you're getting in right here, then I can't tell you where to put your stop marker. Based on the strat, it's not on this sheet, but based on the strat, you can put it at the bottom of this 1 or the bottom of this 2 candle. It's up to you. Me, I prefer to use the 2 candle. If you put it at the bottom of the 1, you're securing more likely you're going to be right because there's more room. You can be right and it still hits your stop marker and you're out of the game and you might have to get back in. A little confusing, but the point is you want to risk as little money as possible just in case you're wrong and you can live to see another day. But that's pretty much it. My battery's finna die on my laptop. I hope you all got an understanding of trading. If you have questions, let me know. This is step by step. Once again, it's Dee Brown Ltd. I hope y'all have a great day and deuces.